Hello, I'm Rick Schumacher with LBM Journal, and I want to thank you for joining today's webinar, The Death Tax Exemption to Decrease by 50%. What does this mean for you? In today's webinar, Sam Brownell will discuss how this potential expiration in a state tax law can have significant implications for independent business owners, affecting their tax liabilities, net worth, succession plans, and overall financial planning strategies. Staying informed about potential changes in the state tax laws, I can't get that right. State tax laws and seeking professional advice are critical for business owners to effectively navigate these complexities. Today, Sam will help you determine whether the estate tax will impact you and will cover strategies for protecting your net worth, regardless whether the estate tax is repealed. He'll discuss whether it's more important for you to plan for the estate tax or for the tax levied on the sale of your business. And perhaps most importantly, what steps should you take right now to prepare for an uncertain future? Sam Brownell is CVA, Certified Valuation Analyst. Yes?
Correct. Yeah.
CFA, Certified Financial Analyst. MBA, Master of Business Administration. I got it. CVA, CFA, MBA is founder and financial advisor at Stratus Wealth Advisors. He's also the sponsor of this webinar. Sam has been a financial pro since 2006 and formed Stratus Capital Management in July 2013, which has since grown into Stratus Wealth Advisors, to provide goals-based financial planning and investment management to individuals, families, and independent business owners. As the firm grew, an increasing number of independent business owners sought Sam's advice on their short and long-term planning needs, including valuation, tax strategy, business continuity planning, and succession planning. In 2019, Sam obtained the CVA certification from the National Association of Certified Valuators and Analysts in order to better serve the valuation and succession planning needs of his independent business owner clients. You can learn more about Stratus Wealth Advisors at stratuswealthadvisors.com. And by the way, Sam will be moderating a panel discussion on succession planning at the LBM Strategies Conference this fall in Costa Mesa, California. So if you want to meet him in person and talk some of the stuff through, that's a good place to do it. Okay, a good couple of things before we get started. All attendees are muted, so you can hear us, but we can't hear you. If you're having technical issues, click the chat button at the bottom of the screen to send us a message, and we'll work to address any problems as soon as possible. If you have questions for Sam, click the Q&A button at the bottom of the screen anytime during the presentation, and he'll address as many questions as possible at the end. And lastly, we expect it to be finished in about 30 to 40 minutes. We are recording it, and we'll send a link of the recording to everyone who registered. We'll also send Sam's PowerPoint presentation. Plus, it will be posted on lbmjournal.com. And with that, I turn it over to Sam.
Great. Thanks, Rick. And thanks, everybody, for attending and for registering. We're looking forward. It's never the most exciting thing to talk about your ultimate demise here, but it's very important because of the fact that we could see a significant change in estate tax law at the end of 2025. So December 31st, 2025, the current rules are going to sunset, and we'll probably end up doing an update on this webinar next year, because depending on what happens in the election this fall, it could have a material impact on this entire area of estate planning and law and regulations. But I think it's really important that as a business owner, you think through this, because you have built a wonderful asset, but it's not a liquid asset. It's a little bit more challenging to figure out how we set up the strategies to make sure that we're protecting our net worth, protecting our family, company, employees. And so we're going to talk through all of that today. So let's jump in. As Rick said, my name is Sam Brownell, and I work at Stratus Wealth Advisors. We do a lot of work. I would say 75–80% of the work that we do is with independent business owners in the LBM space. Our primary goal is to keep the independents independent. We think it's really, really important to the market to have folks who are not part of a private equity roll-up or a larger conglomerate that can serve their market, that know their market, know their customers. And so we do everything from valuation and succession planning to helping individuals and families with their personal financial planning and asset management. So Little cartoon to get us started here. This is something that you hear a lot about, right? The inheritance tax, the death tax, the estate tax, by whatever name it goes by. It's something that is generally painted in a bad light, right? We want to avoid this. Oh, we're going to get nailed because the government wants to take money from us because we've done so well. And so part of understanding how to position yourself is just to understand what are the implications, what are the rules, and where do I fall within that? And as I said up top, it's a little bit more challenging when you're a business owner because you can't just go straight to the stock market, the stock exchange, and figure out what your business is worth. And so that becomes a really, really important piece of the puzzle. And we'll talk about that as we go through the presentation today. So here's what we're going to discuss today. We're going to discuss about the estate tax limit. We're going to review some high level. We're going to talk about how a decrease may impact you. We're going to talk about some strategies to protect your net worth, right? One of the most important things about estate planning is that we are trying to do two things. Number one, we're trying to protect the growth that we've had in our assets. Number two is we're trying to make it as easy as possible for those who we leave behind to administer our estate and to make sure that our affairs are carried out to our wishes. Again, for a business owner, that's a little bit different because you have a business. It's not just like you're passing along some stocks and bonds and maybe a little bit of real estate to your children or grandchildren, right? This is a business. You have employees, you have customers, and so we need to think about this a little bit more. And as Rick mentioned, taxes come in many different forms. The estate tax is just one of them. Regardless of whether or not the estate tax applies to you, there are going to be tax implications for the sale of your business. And so we need to consider those as well, because if we get too fixated on the estate tax, we may miss the fact that what's really going to harm us is the tax on the sale of our business. And we're going to be giving away a lot of money from that actual transaction, not from the ultimate death of an owner or somebody in the family. So, and then we'll finish out with some steps that you can follow. So real quick overview. The estate tax. The 2017 tax law that was passed, it doubled what is called the lifetime exemption. That is the amount of money that you're allowed to move outside of your estate without running into the estate tax. And so right now, those limits are 13.61 for individuals and 27.22 for a married couple filing jointly. These estate tax limits are tied to cost of living adjustments, right? So they will go up every year. So when do you actually get hit with the estate tax? Any assets that are below those amounts are not subject to the estate tax. So if your estate is worth $20 million, you are not going, and you die this year, you are not, and you're a married couple filing jointly, as it says, you are not going to run into any issues with the estate tax. It's when your estate is worth more than that, 30 million, 35, 40 million, right? This is when we start running into the estate tax. And the estate tax is on that. So 27, if you were 30 million minus 27.22, that difference, right? 2.78 million, that will be subject to the estate tax. The highest rate is 40%. So anything $1 million or more above that limit. So right now, if you're a married couple filing jointly, anything at 28.22 million or more gets taxed at 40%. That first million, it's a progressive tax code just like we have now, and it'll step up. So that first $1 million, if you have more than $1 million, it's about $345,000 that you'll pay an estate tax on that first million, and then anything above that will be at 40%. Now, that's just the federal level. Depending on the state that you live in, that may be different, right? Stratus, we're located in the state of Maryland. The state of Maryland has its own state estate tax, and the limit is much lower than the federal limit. So again, you have to be very careful of, do you have both a federal net worth that's above the estate tax, but also are you in a state that charges its own estate tax? Because lots of times the state estate tax limits are much lower than the federal limits. So what's going to happen? Next year, we'll just have an increase for cost of living. The issue comes in order to get the 2017 tax law passed, Congress had to make sure that this was something that was quote unquote revenue neutral, right? It was not going to increase the deficit. And the way they do that is by sunsetting certain tax provisions. And that's what they did here. And so what's going to happen is this estate tax limit is going to be cut in half, reduced by 50%. So just to give you some hypothetical numbers, assuming that we're talking about inflation of 3%, cost of living adjustment of 3% over the next 2 years, and no, Congress doesn't step in. The current level sunset, they're reduced by 50%. We're looking at 7.22 million per individual or 14.44 million per married couple. That's a lot different than what it is now. All right, and this is the reason that we need to start planning for these things and thinking through how we're going to deal with this potential cutting in half of the estate tax exemption. So how do we determine if it's going to impact you? And let's take a very basic look here. We've got a dealer. These are some financials. We know what they have in revenue. We know what their EBITDA margin is. They have a couple locations. Real estate. This becomes a really important piece of the puzzle. A lot of our clients are sitting on real estate that has gone up quite a bit, right? They may have been on the edge of town when the business was founded, after World War II in the 40s. Now they're smacking prime real estate. Their real estate may be worth more than the business, right? That's something that you need to be very, very concerned about. And we're including all of the other assets. What are all the other assets that you own? So step number one, got to get the business valued. This is a very rough, high-level approximation here of what a business is valued, right? But in your estate, what we're looking at is the equity value of the business. What is the equity value of the business? That is, what is the stock or membership units of the business worth to the owner? Right, so we need to establish that. Step two, what is my timeline? Right? How am I going to make sure that I'm aware of where the estate tax limits are and where my net worth is? Right? As you can see from the first to second bullet, you're a couple that's married, filing jointly, business owner dies this year. You've got a 27.22 million exemption. If that same owner dies in 2026, now we're looking, based on our hypothetical calculations, at about 14.5 million. That's a big difference, right? And could be some serious consequences in terms of estate tax. And so this is what the planning is all about. So now let's look at two different examples. Let's put some numbers in here. 2024. What is your estate tax liability given that you've got a business that's worth 11.8 million in equity value, 10 million in aggregate in real estate, and you've got a primary residence, you've got some other liquid assets, maybe in a brokerage account or 401k. If you're married filing jointly, you die this year, you don't owe anything. There's no estate tax due. Okay, now, what happens in 2 years? Congress does nothing, the estate tax exemption gets cut in half. Now, we could owe 3.7 million in taxes. And that's not just an ouch because the number is so high. If you are a business owner, where does that liquidity come from? Where are you going to find the cash to pay those taxes? So these are things that we need to think about. These are things that we need to plan for, because it's always better to be prepared for, in this case, our downside scenario is Congress does nothing, the estate tax the exemption gets cut in half as of December 31st, 2025. Hopefully, most folks are going to live beyond that. And if so, we're going to need to be very careful about how we're planning for the transition of your business, how we're planning for where things are held in your estate. Are they held by you or are they held externally? How are we going to pay for the taxes? All of these different things become really, really important to the planning of a business owner. So protection, right? We got to calculate what we what we potentially owe so that we can start thinking about how we're going to make this a little bit easier to protect. What are we going to do? All right, succession planning. Succession planning is a key. And in our experience, oftentimes folks wait too long. Health event, deterioration in relationship between owners, family member gets sick, so something goes on that all of a sudden it becomes critical. But we want to be planning for this succession, because if we're running a business like it's ultimately going to be turned over to somebody else, we have a business that's more valuable, right? And so we need to think through, who are those potential future owners? Do we have children that are interested, or are the children too young? We don't even know, right? How do we protect those? Do we need to put together some type of trust that will hold the business for the children in the future so that they can make a decision when they get to be 25, 30 years old, right? Are there internal employees? Are there strategic competitors? You know, and are there the others? Folks have probably heard of an ESOP, right? An employee stock ownership plan, you know, worker-owned cooperative, this idea of a perpetual purpose trust, which I'll talk about a little bit later and probably dive into more in another webinar. But these are also, you know, we've got lots of options out there. So we need to explore these options, because the more of our net worth that we can figure out how to transition, how to make more liquid, or how to move outside of our estate, the easier it's going to be to deal with an estate tax exemption that may be cut in half in 18 months or so. Again, part of this transition is transitioning ownership. You know, over what years are we going to do? How am I going to do it? How am I going to mitigate taxes? And there are three things that any good succession plan, any good transition is going to have. One is a transition of leadership and management. One is a transition of ownership. And one is a transition of control. And those are three different things that need to transition in any type of business. And they can be done at the same time, or more often they're done at different times, right? So that an owner, for example, can keep control of the business, even though they have passed most of the worth of the business to somebody else and either been paid for it or gifted or granted it. And so, you know, things to think about, right? Finally, legal documents, right? As we all know, legal documents aren't important until something happens, and then they're critically important, right? So we need to be looking at both sides. Do we have the personal documents in place? Last will and testament, power of attorney, right? Oversee financial, somebody make financial decisions on your behalf. Medical directives, somebody can make health decisions on your behalf. Do we need to involve trusts? Right? Trusts, remember, are a way for you to help the administrators of your estate figure out what you wanted to do with those assets. It's going to lay out who they should go to, how they should be managed, things like that. So do we need to put that stuff in? On the business side, a professional will. This is a very important contingency planning document that we write for a lot of businesses. Who's going to make key decisions if an owner is disabled or dies? Hiring and firing. Who can talk to the bank? Who has access to passwords? Memorializing this stuff makes it a lot easier when something happens. And then this idea of a shareholder agreement. If you're a sole owner and you plan on transitioning over time, let's say you're going to transition 20% a year for 5 years. As soon as you have multiple owners, you need to put a buy-sell or shareholder agreement in place. Okay, this is like your wedding prenuptial, right? It's easy to get into this stuff. It's a little bit more challenging to get out of it. That helps protect the net worth. And these are all the what ifs. Okay, now, this idea of taxes. Estate taxes, very important. We need to prepare for them. We need to look at the net worth, especially planning for the scenario of them getting cut in half. But regardless of whether or not you're going to bump into the estate tax exemption or not, you're going to have to pay taxes or else file a gift tax return on the transition or sale of your business. So what does this look like? We talked about this idea of gifting or granting. These are ways to move ownership of your business to a child in the idea of gifting. Granting would be to a key employee. and you're moving an asset outside of your estate. And that can be an important planning tool here, especially as the second bullet point says, part of this planning process is to figure out what is the business worth? What are your other assets? What are you going to need to support your lifestyle? If you don't need 100% of the sale price, then maybe gifting or granting is a good way to look at moving some of your net worth outside of your estate. Okay. Then there's this idea of how the business is sold, stock versus asset sale. We're not going to dive into the details, but basically from a high level, what you need to know is if I'm selling the stock of my business to Rick, that is almost in every situation going to be taxed only at long-term capital gains rates. The top rate is 23.8%, plus sometimes the states will have their own rates, maybe 5-6% on top of that. Right? An asset sale, right? An asset sale is typically the type of sale that happens if you're selling to a private equity roll-up, strategic competitor. They don't need your business entity. They don't want to take on the liabilities of your business. They just want to buy the operations of your business. That's great. The tricky thing about an asset sale is that it's going to be taxed at a mix of ordinary income and long-term capital gains. Top ordinary income tax bracket right now is 37%. Hey, then you add in state tax if there is some. Again, something to be really, really concerned about. You could end up, if you're in a high tax state, California, New York, you might be looking at a 45% tax on some of the sale of your business if you're selling to a third party. So this could be more substantial than the estate tax. And so again, we have to think that taxes are across the board. There are lots of different ways that the government will collect money. So we need to plan for each one of them. We'll talk a little bit on the next couple slides about this idea of an ESOP co-op, because there are some tax benefits to each of these if they're structured right. And then finally is this idea of this, we talked about a little bit earlier, this perpetual purpose trust. This is something that is used a lot overseas, Australia, Great Britain, places like that. But this is a trust, so you can gift the business to the trust. You can sell the business to the trust at fair market value. But this perpetual purpose trust holds the business, and then it has the ability for the owner to say, "Here's what I want this trust to look like." It's very flexible. Maybe I'm going to gift it to the trust, and then I'm going to get paid out until the letter of my wife or I die. We're going to get paid out $200,000 a year, right, as an annuity over time. So it can be very flexible. You can set up a lot of different structures around this. And for a lot of folks we see considering these perpetual purpose trusts, there's a reason beyond just the business. They want the business to continue. They want their employees and their customers to be happy. And the trust owning it will help keep that business independent. But the flip side is folks may want to give to other causes. There may be something else that's very near and dear. And this is an industry that loves to give back. And so a perpetual purpose trust can be a great way to memorialize, hey, we need to continue to provide to local charities, to the church, to the fire station, whatever the case may be, to protect the environment. These are things that you can put into one of these perpetual purpose trusts. And again, it can be a way to move assets outside of your estate in a manner that makes it a little bit more efficient, both from the selling tax, but also from the estate tax. So a couple things to think about there. All right, this idea of worker ownership, right? ESOP, worker-owned cooperative. These can be very, very interesting to set up, especially if you're sitting there going, geez, well, my kids don't want the business. I don't think it's right to, I don't really feel like I have one or two employees that could take this over. Well, we can sell to a broad-based group of employees. And as long as we have a good management team in place, there can be some very good long-term tax benefits for both the selling owner and for the company, right? So it needs to be set up a specific way, right? C corporation, S corporation, LLC taxed as either one. are typically the best ways to do this, but it doesn't have to be. And I think the important thing to note here is fair market value. You can get paid fair market value for this type of transition. And there are a number of folks in the industry who you can talk to who have gone both routes, right? Both ESOP and worker owned cooperative. In fact, I think a couple of years ago, Jay Ward from Ward Lumber spoke at the LBM Journal, LBM Strategies Conference about his transition to worker owned cooperative. So reach out to us. We can put you in touch with some of these folks, and you can hear from your peers, because don't feel boxed in is what I'm saying by, oh my gosh, how am I going to do this? It doesn't seem like anybody in my family wants the business. I'm stuck. There are more options. So make sure you explore all of them, I think, is the key here. So how can these help? So if you're a C corporation, one of the benefits of doing a stock sale is that you avoid double taxation. Well, if you're doing this worker ownership idea, you could potentially avoid double taxation in an asset sale, which could be good, right? Because remember, a C corporation gets taxed at the corporate level, and then anything that gets distributed gets taxed again at the individual level. So if I sell my company to Rick, I'm going to get taxed at the corporate level. Rick's going to write me a check, or the bank's going to write me a check, and I'm going to walk away with, let's say, $5 million. Well, now I've got $5 million that's sitting in a C corporation. Every time I take that money out to distribute to myself, I get taxed again. So trying to avoid that double taxation can be very helpful. The other thing with C corporations is if you're selling to an ESOP or a cooperative, and you can sell more than 30% in year one, and you can come up with that value in cash. Let's say your business is worth $5 million, right? 30% would be $1.5 million. If I can turn around and invest that $1.5 million into stocks or bonds of US corporations, I can defer capital gains tax on that sale. That's pretty powerful. Right? And an ESOP has a step farther, because remember, an ESOP is like a retirement plan. When you sell to your workers through an ESOP, each of them gets a slice of shares that becomes part of a retirement account. Well, as anybody who has a 401k knows, any gains you have in the 401k don't get taxed. So an ESOP that is an S corporation, any profits for whatever portion of that ESOP is owned, right? So let's say you sold 30%, right? The 30% of the profits that are owned by that ESOP, if you're an S corporation, you don't pay taxes on those. That can be pretty powerful. Can also mean that there's more cash available to not only pay out the departing owner, but also invest in the business, invest in employees. So different things here, just trying to put some different ideas in folks' heads about how do we diversify away from the traditional, oh, my kids don't want the business, I guess I'll have to find a third-party seller. Well, there are lots of ways that we can avoid taxes, both from the sale and from the estate purpose. So what do you do right now? Right, that's a ton of information in a short period of time. So what do we do now? ABCs is what we like to call it. Appraise the business, build your succession plan, calculate your net worth. Keep that in mind. And the sooner you can get an idea of what the business is worth, look at that with your other assets, the easier it's going to be to do some of this other planning, less scary it's going to seem. But you do need an appraisal of the business. And in fact, if you own real estate, you need to get that real estate appraised too, because chances are that real estate's worth a lot more money than it was 30, 40 years ago when you took over the business. So remember, ABCs, appraise the business and the real estate, build your succession plan, calculate your net worth. Reach out to us. We're happy to help. Okay, we have complimentary consultations with folks all across the country. Our job is just to put a couple ideas in your head. Okay, so please use us as a resource. We're happy to put you in touch with peers who have been through this, because it really is useful sometimes for you to talk to somebody else who's been in that position, and they can help you think through and talk about how they tackled some of these challenges. So with that, turn it over to Rick for some questions.
Yeah, thanks, Sam. We have some really, really good questions, and about regarding Sam and his capabilities and what he does. He's really good at what he does, and we're working with Sam and his team on our succession planning with LBM Journal. So, so yeah, he knows his stuff.
Appreciate it, Rick.
Yeah. Okay. First one. What makes an estate or gift tax valuation different from a valuation for the sale to a third party?
Yeah, excellent question. So two things in particular. Number one is it's going to depend on, for a state gift tax, how much, right? What is the percentage of ownership you're turning over? If, let's say, I'm only going to do, if I'm going to grant a 20% interest to Rick, then I'm going to take full advantage of the discounts I can use. Discount for lack of marketability, discount for lack of control, because that 20% share is not going to be able to outvote me, right? If I'm giving Rick a 20% share of my business, I still own 80%. And so we're going to be able to take advantage of these discounts, which means we can reduce the value of the business, which means it gives you more room underneath that estate tax exemption. So that's a pretty powerful tool there. The other thing that I would say is in who is the ultimate reader, right, of the report. And if I'm working M&A, I'm not taking any discounts because we want to negotiate from the highest price possible. But also it's going to be another party, right? It's probably going to be either another company or a private equity group who is going to be looking at this. It's a little bit different with a gift or estate because it's the IRS. And so we need to prepare a report that not only discusses how the value was determined, but also defends why we got to that particular value, because the goal is not to end up in tax court, right? And you see folks end up in tax court when they try to ram through a valuation that's artificially low based on their company, just so that they can have more room under the estate tax exemption. And so we definitely don't want to do that. And we want to be as objective as possible, but we also want to use every trick in the book to make sure that we can make this work for you, your family, and your plan.
All right. I'm the sole owner of my business. How is my estate planning different from someone who has business partners?
Yeah, excellent. That's a really good question. So again, a couple things to think about here is if you're the sole owner, contingency planning becomes super important because there is no backup, right? If something were to happen to you, who's the one who's making these key decisions? And so this is where what we like to have folks think about who are sole owners is we call it the stoplight chart, right? And so red, yellow, green. What are the roles and responsibilities that you have as the owner? Which ones are easy to transition? They go in the green lines. Ones that are a little bit harder in the yellow, and things that are very challenging, things like relationships, purchasing, right? I'm the one that does all the purchasing of the commodities. Those then become in the red. And so as a sole owner, you really need to think through it. Who would take over these roles and be very clear? That gets back to that idea of a professional will. Now, for multiple owners, professional will still is important, but there it's more of, okay, so let's say that Rick and I own the business with one other person, right? So if something happens to Sam, well, Rick can probably take on a few of my duties. Our co-owner can take on a few duties, at least in the short term. And so we've got a little bit more flexibility for how we set up the actual transition of roles and responsibilities. And then, of course, there's the idea of ownership, right? If I'm the sole owner, what happens? The business now is owned by my estate if I'm not really thinking through it, and maybe it doesn't go into a trust I haven't really thought through. So now what happens? Well, my poor spouse might be left there thinking, I can't run this business. What do I do? And so again, planning becomes important. For the co-owners, this is that idea of that shareholder or buy-sell agreement. And if something were to happen to one of the owners, how are we going to pay them out? How are we going to make sure that their family is able to get some liquidity out of this so that they can pay estate taxes if they need to, they can pay final tax returns, but we also don't have a party who's owning the business that's not involved in the business. So, a lot to unpack there, but those are some of the high level things to think about between whether you're a sole owner or a co-owner, multiple owners.
Got it. Yeah, there's so many things to think about in all these different scenarios. Okay, if my kids don't want the business, how does that impact whether the estate tax will impact me?
Yeah, so that's a really critical one to think about. And so gifting, this idea of gifting shares in the business, gifting applies to family members, to children, right? You can't gift to a key employee. You can grant to a key employee, but you can't gift. And the difference is that if I, if Rick and I are in the same family and I want to gift some shares to Rick, then I get the business valued. We file a gift tax return, and that whatever my business is worth, let's say the shares that I'm giving Rick are worth $2 million. That then goes against my estate tax exemption. So let's say that I married 27.22 minus 2 million. Now I've got 25.22 million to play with in terms of my estate tax exemption. So that's gifting. Granting is a little bit different because if I am granting to Rick, we're not in the same family, he now is going to have to pay taxes on the amount that was granted to him. And so that can be different. I mean, it's better than having to pay $2 million, but still taxes on $2 million can be pretty high. And so for folks that don't have children, thinking through some of these other strategies for, will an ESOP work? It does in some cases, it doesn't in other cases. Will a cooperative work? Again, it's going to be specific. Will this idea of a perpetual purpose trust work? Maybe it's more flexible, right? And you could potentially gift to that perpetual purpose trust and then receive ongoing payments coming back out. And so there are different ways to structure it if you don't have kids that are interested in the business, but it makes it a little bit trickier and you have to look at more options.
Got it. Okay, other than death, what are the material events I should have in my buy-sell agreement?
Yeah, another great question. So typically buy-sell agreements will cover death, which is important, right? If an owner dies, we need to make sure that we can buy back shares from that owner. The other ones that are important, disability, right? Folks think about death. In our experience, the two that happen way more than death are disability and divorce. So we need to have contingencies in place that if Rick and I own the business together, I get in a car accident, I'm in a coma, I can't perform my job functions for 6, 12 months, let's say. What happens? What happens to my shares? Can I still be an owner of the business? Am I still providing the value that I could? Maybe, maybe not. That's on a case-by-case basis, but I think it's important to think through that. Divorce becomes a really important one, just because the last thing we want is a disgruntled ex-spouse owning shares of your business. That's a recipe for struggle. And so we can think through how are we going to buy those shares back. If you know that you're going through a divorce proceeding, that could trigger right there a buyback of shares so that they don't end up getting divided in court. So those are some big ones. Other ones that are important, personal bankruptcy. It doesn't happen a lot. We've seen it in rare occasions. Still important to cover retirement, right? At some point, the co-owner is going to retire, and how are we going to buy them out? And then finally, termination, right? And this is something that could be either for cause or not for cause. And that is also where it's important in these different ones that we're thinking about what is the actual value in these different trigger events. If Rick and I work together and Rick is retiring, well, I'm going to give Rick fair market value for his shares because he's worked long, he's put in his time, he's built this business. If Rick is embezzling money from the company, I don't want to have to turn around and pay him, right? Because he's messing up our company, right? He's doing something illegal with our company. So it's the trigger events, and then it's what is the value that's associated with that becomes really important in these buy sells. And like anything, it's just being very transparent. Everybody knows what they're getting into here. So it doesn't become well, wait a second. Why am I getting that? Well, it's very clearly written in this document, and it's that helps to keep things above board.
Right. All right. Looks like we have time for maybe one or two more. Is an appraisal of the business different than a valuation of the business?
Yeah, good question. So Folks use those interchangeably sometimes. At the end of the day, typically when you're talking about a business, it's a valuation. When you're talking about real estate, it's appraisal. But don't get confused. They essentially mean the same thing. What you're trying to do is figure out the value of an illiquid asset, right? Something that isn't either in cash or on a stock exchange where I can look up very easily and say, okay, I own 100 shares of this stock. Its price is $100. You know, I've got $10,000 of value there. So appraisal valuation doesn't use them interchangeably. So don't get confused, but that's a good question.
All right, and our last one. What value is determined when completing an estate or gift tax valuation?
Yeah, so what value is determined? That's very good. And that kind of gets back to that first question, which is what are we valuing? Are we valuing a minority or are we valuing a control position? And so typically in any estate tax valuation, you're going to be able to take what's called a discount for lack of marketability. And that's basically saying that a privately traded business, all things equal, is not going to be worth the same as a publicly traded business because of the fact that there's no ready market for the shares, and it's going to require certain costs, legal costs, accounting costs, time value of money, right? My money is tied up in the business when it could be invested in the stock market, M&A, broker type costs. So those are typically applied regardless of what interest is being gifted or granted. And the other one is, the big one is lack of control, right? Is the interest that is being gifted or granted going to be a minority interest? If I'm giving Rick 20%, that's great, but he's not going to have control. He's not going to be able to set the strategy of the operations of the company. And so that then becomes an important part. So typically what you see in an estate tax is either a control non-marketable value or a minority non-marketable value. Those are the two valuations that are most often done in estate and gift tax valuation work.
All right, good questions, good answers, and we are out of time. So Sam, thanks for joining us. Everybody, thanks for tuning in today. And Sam will be back with another webinar with a topic to be determined, and he'll also be at LBM Strategies this fall. So
excellent.
Yeah, so we'll hope to see you there.
Looking forward to it. Thanks, Rick. Take care.
See you next time.